When central banks raise interest rates, it's big news.
Bankers judging that the only way they can try to pull down inflation is to carry on raising interest rates.
Rising interest rates that will make the cost of borrowing go up.
Let me ask you something. What if I told you that a single number decided by a group of people you will never meet could make your rent unaffordable, crash the stock market, and even cost you your job? Sounds dramatic, right? But that's exactly what happens when interest rates go up. You have just bought your dream home. The mortgage is tight but manageable. Then the central bank raises rates overnight. Your monthly payment jumps by hundred of dollars. Same job, same houses. But now you are scrambling to survive. That's the power of interest rate. And here's the scary part. They don't just hurt families, they choke businesses, bankrupt governments, and send shockwave through the global economy. Some of the biggest financial crises in history started with rising rates. So today I am going to break it all down. Simply, clearly, and without boring. An interest rate is just the cost of borrowing money. If you borrow $100 from me and I say pay me back $105, that extra $5 is interest. In percentage, it's 5%. On a small scale, interest rate decide how much your mortgage costs every month, how fast your credit card balance grows, whether you can afford that shiny new car loan. For businesses, they decide if opening a new store is possible or too risky. For governments, they decide whether managing trillions in debt is sustainable or a ticking time bomb. When central bank raises rates, money itself becomes more expensive. Suddenly, loans, EMIs, credit lines, everything costs more. Businesses stand over their expansion plan and government cut their budgets. But interest rates don't just affect borrowers, they ripples into everything. Stock market usually fall because companies had expensive debt. Real estate slow down as mortgage climb. Even savers feel it because finally banks pay a little more on deposits. So if interest rates are the powerful, why should anyone raise them? Simple answer: to fight inflation. Inflation is when prices rise too quickly. You feel it when grocery that cost $100 last year now cost $110. Your money buys less and your salary suddenly feels smaller. When inflation gets out of control, central banks step in. They raise interest rates to cool things down. The logic is, if borrowing gets more expensive, people spend less. If people spend less, demand drop. And when demand drop, prices stop rising so fast. Sounds amazing, right? But here's the problem. Rising rates is like giving medicine with a nasty side effect. Sure, it lowers inflation, but it also slows the economy. Think of it like this. You have got a fever. The doctor gives you a strong pill. It brings the fever down, but it also knocks you out cold. That's exactly what high interest rate do to economies. Here's where it gets personal. Rising interest rates squeeze everyone. For families, mortgages rise. That $1,200 monthly payment can suddenly jump to $1,800. Credit cards, forget it. The debt snowballs. Car loans, too expensive. Vacations, cancel. Even Mickey Mouse feels the pain when family skip Disneyland. For businesses, loans for factories, offices, or new hires cost more. Startups lose funding. Companies freeze hiring or cut jobs. For investors, stocks fall because profits shrink. Real estate slow because mortgages climb. Bond value crash when new bonds pay higher rates. And for government, their debt become a monster. America's $34 trillion debt cost billions more just in interest rate. That's money that could have gone to healthcare, schools, or infrastructure. It's a domino effect. Families cut spending, businesses earn less, layoffs rise, governments cut back, and market in panic. And the worst part, rate hikes don't hit instantly. They take almost 6 to 12 months to fully show their impact. It's like eating a chili pepper. At first you feel fine, then the burn hits and you are in pain long after the bite. Here's what most people forget. When the US or Europe raises interest rates, the entire world feels it. Here's why. Global investors chase safe returns. When the Fed raises rates, suddenly US bonds look more attractive. So money flows out of emerging markets back into the US. For developing countries, this is a nightmare. Their currencies collapse because money is leaving. And if they borrowed in US dollars, their debt repayments skyrocket. This exact scenario triggered the Latin America debt crisis in 1980s. Even today, countries from Turkey to Argentina to Sri Lanka suffer when US rates climb. Their imports get more expensive, their debt harder to pay, and investors vanish overnight. So interest rates aren't just about America's mortgage costs. They decide whether entire countries prospers or default. In short, when Uncle Sam sneezes, the rest of the world catches a cold. So, are rising interest rates always bad? Not exactly. Sometimes they are necessary, like antibiotics. A small dose cure inflation, but an overdose it can kill the patient. Here's the big picture. What are interest rates? The cost of money. Why raises them to fight inflation? How do they hurt? By crushing families, businesses, and governments. Where's the impact? Everywhere, from Wall Street to emerging economies. Who gets hit? Pretty much everyone. The central bank's job is to find balance. Too little action is equal runaway inflation. Too much is equal to recession, unemployment, and global chaos. That's why every tiny rate announcement sends shockwave through markets. Because behind that small percentage point is the fate of millions of jobs, homes, and futures. So next time you hear the Fed raised rates, don't shirk. Number isn't just on chart. It's tied directly to your wallet, your job, and your future. This is the Vesto explained simply but seriously.